Hi everyone, welcome. I just wanted to go over a little bit about Chapter 1. Before we get into this, make sure you have a copy of the Chapter 1 examples and the Chapter 1 study guide. And the first thing I want to mention is the accounting equation, assets equal liabilities plus owner's equity. It must always be in balance. Owner's equity is your owner's capital, which would be investments by the owner, minus any drawings by the owner, plus your revenues, and minus expenses. So all four components are part of owner's equity. After each and every transaction, this accounting equation must be in balance. So assets must always equal liability plus owner's equities. A few of the assets that are introduced in this chapter: cash, which we all know, accounts receivable. An example of an account receivable is you perhaps go in the store and purchase something, but you don't pay for it, you charge it. You are then an account receivable to that business. Another item that's introduced is equipment. Equipment is an asset that you're going to utilize for over more than the current period. So for example, if I bought a desk and I'm going to use it for 3 years, that's going to be equipment. So it's something that's going to go beyond the current accounting cycle. I believe, supplies is introduced also. Supplies are little things you're needing the day-to-day transactions of your business, just staplers, paper clips, things such as that. Your assets are arranged in order of liquidity. Most liquid first, cash being the most liquid would be the first item. Liquidity means ease to convert into cash. Liabilities, that's monies you owe, right? Your assets are resources you own. Your liabilities are items you owe somebody. Accounts payable is a short-term liability. For example, you go to a store, you purchase something, you charge it, that is now an account payable to you. It's something you're going to pay within the next operating cycle, within the next 12 months. You might have long-term liabilities also. They mentioned notes payable in the text. Notes payable can be either short-term or long-term. If the note payable will extend beyond the current accounting cycle, then it's a long-term note payable. The accounting cycle generally runs 12 months, so you assume anything is a current asset or a current liability if it's going to be converted within the next 12 months. That's basically how you make your determination. If you look at the first page of Chapter 1 examples, I've given you a number of 8 transactions, and I have shown them listed out so you see them how they fall in to these categories. We're going to do them together, but I don't have enough room, so we're going to divide them between assets, liabilities, and owner's equity. And I believe this is going to help you when you're looking at or trying to do problem 3 of the homework. This will help you for that. So the first thing is ACOM begins a computer service business. Cash investment is made of $12,000. Well, that is going to increase an asset account, right? It's going to increase our assets by $12,000. And it's going to increase our equity. That's capital, right? It's going to increase our equity, $12,000. The next transaction is we purchased office equipment for $3,000. Okay, office equipment is an asset account. So we purchased office equipment for $3,000. We pay $1,000 cash. $2,000 goes on to credit. We're going to have an increase of $3,000 for the equipment. And we're going to have a decrease of $1,000 because we paid cash. Our liabilities are going to increase by $2,000. We paid cash for $1,000, and the other $2,000 we purchased on account. Next item, purchase supplies for $400. Supplies are asset account. It's going to increase because we've got supplies. That increases our assets accounts by $400, and we use cash to buy it, so that's going to decrease our asset accounts by $400. The next thing we do, we perform services of $10,000 and we bill customers on account. That's an account receivable to us, so that's going to increase our assets by the $10,000. And we are going to have an increase in owner's equity. of 10,000. The next thing we have is we have an owner's drawing, right? The owner withdraws $600. That's going to decrease we're going to have a decrease of an asset account for 600, and we're going to have a decrease in equity of 600. The next thing we do is we pay expenses, and 6, 7, and 8 are all paying expenses. The first one we pay rent with cash for 1,000. So that's going to decrease our asset account by 1,000. Also decrease our equity by 1,000. Next thing we do is we pay salaries of 5,000. Same thing, we're going to decrease assets by 5,000, and we are going to decrease our equity by 5,000. Last thing we're doing, we're paying expenses for utilities. Again, paying with cash, decreasing an asset account by 500, decreasing an equity account by 500. So you can use this to help you when you're solving exercise 3 of the homework. Also, for 1 and 2, problem 1, I think the study guide will help you with 1 and the text. 2 also, you can get help with the text. For homework problem 4 and 5, I've actually, within the study guide, I've given you written instructions for that. I also have for problem 6, but I'm going to go over it a little bit towards the end of the video lecture. And let me just mention both problem 8 and 10, excuse me, you need to know the income statement and owner's equity for 10, so, or I believe for 8, I'm sorry. So let me go over that very quickly. Your income statement. It is revenues minus expenses. That's all it is. And that will either give you net income or net loss. If your revenue exceeds your expenses, you will have net income. If your expenses exceed your revenues, you will have a net loss. If you're looking at owner's equity, so that's our income statement. If you're looking at owner's equity, you're going to start with beginning capital, and I believe problem 8 you need both for. Problem 10 is basically just the income statement. You're going to start with beginning capital. You are going to add net income. You are going to subtract your drawings, and that's going to give you your ending capital. Also, look at the study guide, the examples I've given you. I've given you a balance sheet example, income statement example. There's an example of owner's equity. So if you follow that also, that will probably help you with 8 and 10. Problem 9, the balance sheet they've given you is incorrect, and you just need to rearrange it to show it correctly. And that is it. I want to go over problem 7 and then a little bit of problem 6. So we're going to stop here for just a moment.